I'm Dr. Sonal Babbar, an Associate Professor in the Department of Commerce, Maitrey College, University of Delhi. Through the previous video, we understood the legal provisions applicable for income from house property. We looked at the theoretical aspects. Now, with the upcoming video, we are going to look at the computation to be done for income from house property, which is a let-out house property. In this video, we are going to learn how to compute income from a let-out house property. So we begin with gross annual value, which is shortened as GAV. We deduct municipal taxes which are paid by the owner during the relevant previous year. And after the difference between the two gives us net annual value, NAV. And from that, we provide deductions under Section 24. Section 24, subsection A, provides a statutory deduction, which is 30% of net annual value. And Section 24, subsection B, provides interest on borrowed capital, which is allowed as deduction on accrual basis. The final value we get is income from house property, which is a let-out house property. So here, the two things which we have to consider is, one, municipal taxes paid by the owner during the relevant previous year. That means municipal taxes will be deductible on paid basis. And interest on borrowed capital will be deductible on accrual basis. So even if the assessee or the owner of the property has not paid the interest on borrowed capital during the relevant previous year, it will still be allowed as deduction. So let us now elaborate and understand what are the meanings of these terms taken there. Step 1, we need to compute gross annual value, which is GAV. For that, we need to compute expected rent of the property. We need to compute actual rent received or receivable of the property, and then we compare the two. We consider the higher of the two, and from that we subtract loss due to vacancy. So let us repeat this. We are comparing expected rent with actual rent received or receivable. We are considering whichever is more. From that, we are subtracting loss due to vacancy. And the answer is GAV, which is the beginning of, or which is the first value of this table. Meaning of expected rent. For expected rent, we compare municipal value or fair rent. We consider whichever is more, but this is subject to standard rent. So from these two, we take whichever is less. That becomes expected rent. Coming to it, expected rent is municipal valuation or fair rent, whichever is more, subject to the standard rent. Now, what is municipal value? Municipal or local authorities charge house tax on properties in their area. For this purpose, they have to determine the income earning capacity of the property. And to calculate the amount of house tax, that income earning capacity of the property is computed by the municipal authorities. This annual letting value is computed after taking many factors into consideration. And therefore, municipal value can be taken as important guiding factor in arriving at the annual value of the house property. So municipal valuation is given by municipal authorities, and it is an important proxy for annual value of the house property. Second is fair rent. It is a market value of a similar property in the same or similar area. It is the rent normally charged for similar house properties in the same locality. For example, I own a house in Lajpat Nagar and I want to know the fair rent of a property similar to mine. Maybe I locate a similar property in the area, let us say Amar Colony, and I compare the two localities. Since the localities are nearby and the similar house properties are there in those areas, so it will let me know the rent which is normally charged for such house properties in such localities. So that will give me the amount of fair rent. So that is the second figure. Then comes the standard rent. Standard rent is the maximum rent which a landlord can legally recover from his tenant under a Rent Control Act. So it means if a property is covered by a Rent Control Act, the landlord cannot expect a rent higher than the standard rent. This is in fact coming from a leading case of Supreme Court, where the property subject to Rent Control Act, its annual value under Section 23, subsection 1 cannot exceed the standard rent fixed or determined under the Rent Control Act. In computing the annual value of a house property, expected rent is subject to the standard rent. So it cannot exceed the standard rent if Rent Control Act is applicable on a area in which the property is located. This was decided in Sheila Koshish versus CIT. So the three values which we are considering, MV, FR and SR. So repeating about expected rent, municipal value or fair rent, take whichever is more, subject to standard rent, take whichever is less. That becomes expected rent. Next, we consider is the actual rent received or receivable. So we take annual rent or we can say rent of the previous year for which the property is available for letting. That is taken as annual rent. And from this, we are going to subtract unrealized rent provided certain conditions are satisfied. Unrealized rent, that is, the tenant has defaulted and has not paid the full rent to the landlord. So on account of landlord, that rent goes unrealized. So unrealized rent with some conditions, since asterisk is marked here. So conditions satisfied, only then it will be allowed to be subtracted. So AR is annual rent or rent of the previous year for which the property is available for letting, and we subtract unrealized rent from here provided the conditions of Rule 4 are satisfied. Conditions of Rule 4 are that the tenancy is a bona fide tenancy, that is, it is genuine tenancy. The defaulting tenant has vacated or steps have been taken to compel him to vacate the property. The defaulting tenant is not in occupation of any other property of the assessee. And further, the assessee has taken all reasonable steps to institute legal proceedings for the recovery of the unpaid rent or satisfied the assessing officer that the legal proceedings would be useless. So here, if these four conditions are satisfied, which suggests that the landlord has taken all due steps to realize the amount of rent, however, it still remained unrealized. So, if these four conditions are satisfied, we say the conditions of Rule 4 satisfied, and therefore unrealized rent will be allowed to be deducted from the rent of the previous year for which the property is available for letting to get the actual rent received or receivable. So bringing you back here one more time, that for computing GAV, we need to get expected rent, compare it with actual rent, whichever is more is taken, and we subtract loss due to vacancy to get the gross annual value. So let us take one question and understand how to compute gross annual value in case of the following house properties for the assessment year 21-22. The amount in rupees is given to us. There are 5 properties in question, property 1, 2, 3, 4 and 5, and the municipal value, fair rent, standard rent under the Rent Control Act, annual rent for 12 months, vacancy period is specified in number of months, unrealized rent of the previous year 2021 is given where it says conditions of Rule 4 satisfied, and unrealized rent of the previous year 1920 is also given. Here, when we are subtracting the unrealized rent, we have to add one more point here, that the conditions of Rule 4 must be satisfied, and also the unrealized rent of only the relevant previous year will be allowed to be subtracted. That is, the unrealized rent of earlier previous years will not be allowed to be subtracted here. So let us look at property 1. To find out GAV, we require expected rent, and for expected rent, we require municipal value or fair rent, whichever is more, subject to the standard rent, take whichever is less. So this becomes ER. MV is given as 1,95,000 and FR is given as 1,97,000. So whichever is more is FR. Standard rent is 2 lakh. So 197, which is the fair rent compared with the standard rent, and lesser of the two is taken, which becomes expected rent for us. Next, we compare it with actual rent. Actual rent is the annual rent minus unrealized rent provided the conditions are satisfied, and this unrealized rent must be of the relevant previous year. So annual rent is available, which is 2,02,000, and unrealized rent of the previous year 2021 is 2,000. So I'm going to subtract this unrealized rent from the annual rent, and I get 2 lakh as the actual rent. Now we need to compare ER with AR, and we take higher of the two. We take whichever is more. So higher between 1,97,000 and 2 lakh is 2 lakh. From this, we subtract loss due to vacancy. And that loss given in the question is for 3 months. So the annual rent for 12 months is 2,02,000. So if the loss due to vacancy is not given in amounts, then we take 2,02,000, that is the rent for 12 months, into 3 months. Okay, so this amount comes as 50,500. So we are going to subtract 50,500 from here, and we will get GAV, which is 149,500. So let us look at it once again. We are dealing with house property 1, where expected rent is to be computed, and we pick municipal value, compare it with fair rent, take the higher of the two. So 1,95,000 or 1,97,000. Higher is 1,97,000. So we take that value, but it has to be subject to the standard rent. That means expected rent cannot exceed the standard rent. Therefore, lesser of the two will be taken. And as a result, expected rent is 1,97,000. Then this has to be compared with actual rent, which is annual rent minus unrealized rent of the relevant previous year, provided the conditions of Rule 4 are satisfied and the question specifies the Rule 4 conditions have been satisfied. So we take the annual rent, the rent of the previous year for which the property is available for letting. So it is 2,02,000 minus 2,000, and that gives us 2 lakh rupees. Between the two, we take higher, and 2 lakh is the higher, so we continue with that figure, and we subtract loss due to vacancy here, which is 50,500. How do we compute this loss? We take the annual rent, which is divided by 12 to get a month's rent, and the property was vacant for 3 months, therefore it has been multiplied by 3. And the amount that comes for the loss due to vacancy is 50,500. So the difference gives us the GAV. Let us look for property number 2. The municipal value is 1,86,000, fair rent is 1,87,000, standard rent is 1,85,000. So for house property 2, again we need to compute expected rent first. So municipal value or fair rent, whichever is more, compared with standard rent, whichever is less, will become expected rent. So municipal value given in the question is 1,86,000, fair rent 1,87,000 and standard rent 1,85,000. So 1,86,000, 1,87,000 and 1,85,000. So higher of the two is 1,87,000 here, but lesser of the two is 1,85,000. So ER is fixed at 1,85,000. Next, we look at the annual rent for 12 months, which is 1,86,000, and there is an unrealized rent of 6,000 with a vacancy period of 1.5 months. So what do we do here? To get the actual rent, we take annual rent and subtract from it the unrealized rent with an asterisk marked over here, suggesting that the conditions of Rule 4 must be satisfied. So annual rent is 1,86,000 and subtracting 6,000 from it. And here the annual rent for second property is given as 1,84,000. There is no vacancy, nor there is any unrealized rent. So annual rent 1,84,000, no unrealized rent. So 1,84,000 becomes the actual rent for us. We need to compare these two figures and take whichever is more. So we take 1,85,000 and subtract loss due to vacancy, if any. Since the property was not left vacant during any time of the previous year, therefore loss due to vacancy is also nil, and we get GAV, which is 1,85,000. So let us look at this table which provides the GAV for remaining properties as well. So here in the table we see the GAV for property 1, property 2, property 3, 4 and 5. So we have discussed the computation of GAV for property 1 and 2 in detail. Now let us look at property 3, where 1,50,000 is the MV and fair rent is 1,46,000. So higher of the two is taken, which is 1,50,000. And here the standard rent is not applicable. Therefore, 1,50,000 will be taken as the expected rent. This is ER. And this is to be compared with actual rent, which is rent of the previous year minus unrealized rent. So rent of the previous year was 1,86,000 and unrealized rent 6,000 has been subtracted to get 1,80,000 here. This is actual rent. Higher of the two will be taken and we subtract loss due to vacancy. Again, the annual rent divided by 12 into 1.5 will give us 23,250 and the difference is coming as GAV. Similarly, for property 4, we see that municipal value, fair rent and also the standard rent all are of the same figures, and therefore 1,12,000 will become expected rent. This will be compared with actual rent, which is rent of the previous year minus unrealized rent, and that comes as 1,16,000. Higher of the two is taken, and from that we subtract loss of rent due to vacancy, which is 40,000 rupees. So the difference is taken as GAV. In case of property 5, the municipal value is 1,70,000, fair rent is 1,63,000, higher of the two is municipal value, which is to be compared with standard rent, which is 1,88,000. Lower of the two will be taken as expected rent. That will be compared with actual rent. Here, actual rent is coming as 1,80,000, which is rent of the previous year minus the unrealized rent, provided conditions of Rule 4 satisfied. Higher of the two will be taken, which is 1,80,000. And vacancy period 7 months is given, and therefore 1,08,500 is the loss due to vacancy, and 71,500 will be the GAV. So let us look at property 5, where the municipal value is 1,70,000, the fair rent is 1,63,000. So we take the higher of the two, which is 1,70,000. Compare it with the standard rent, and it cannot exceed the standard rent, therefore 1,70,000 is the expected rent. Actual rent is the rent of the previous year minus unrealized rent, which is 1,86,000 minus 7,000. That gives us 1,79,000. And higher of the two is taken. And after that, we subtract loss of rent due to vacancy, which is 1,08,500. And we get this by dividing 1,86,000 by 12 and multiplying this by 7. So the difference, what is coming, is GAV for us. The point to remember is that the unrealized rent will be subtracted from actual rent, provided the conditions of Rule 4 are satisfied. And also the unrealized rent of the current previous year will only be deducted, and unrealized rent of the earlier years will not be allowed as deduction. Step 2, that we deduct municipal taxes. Once the gross annual value is computed, the next step is to subtract municipal taxes. The municipal taxes which are levied by municipal authorities, if are paid by the owner during the relevant previous year, only then they will be allowed as deduction. If the municipal taxes are paid by the tenant, they will not be deducted. If the municipal taxes are outstanding, they will not be deducted. If the municipal taxes are deducted in the previous year in which they are actually paid, and if during the previous year the owner pays municipal taxes pertaining to some earlier years, deduction will be allowed to the assessee, provided such taxes were not allowed as deduction in the earlier years. While we subtract municipal taxes from gross annual value, we get net annual value. This is actually the annual value under Section 22 of the IT Act. This is indeed annual value in the words of law, and the calculation of NAV is the most significant step for calculating IFHB. Can NAV be negative? Yes, if municipal taxes paid by the owner during the relevant previous year exceeds the gross annual value of the property, it can make net annual value negative. Now, another question where we are finding out the net annual value in the case of following house properties for the assessment year 21-22. Now, with the help of this question, we will find out the net annual value in the case of following properties. Again, 5 properties are given in the question. And municipal value, fair rent, standard rent under the Rent Control Act, annual rent, vacancy period in months, unrealized rent of the previous year 2021 given, and also the municipal taxes paid by owner given. It says the taxes paid by tenant in case of property 2 and 4. So since the municipal taxes are paid by tenant in these 2 properties, therefore no deduction will be allowed for property 2 and property 4. For property 1, municipal taxes are paid by the owner, so they are allowed on paid basis. Property 3 paid by the owner, and property 5 paid by the owner. So these 3 are allowed, but property 2 and 4 not allowed. So let us compute. For computing NAV, we require GAV. From that, we subtract municipal taxes, and which are paid by owner during the relevant previous year. and what we get is net annual value. So GAV, let us work for property 1. Similar way, the way we did in the previous question. So municipal value will be compared with fair rent. Take the higher of the two, which is 1,97,000. Compare it with the standard rent. Take the lower of the two, so which is again 1,97,000. So 1,97,000 becomes expected rent. Then we compare it with actual rent, which is annual rent minus unrealized rent. So actual rent will be 2 lakh rupees. ER or AR, whichever is more, taken. So 2 lakh is taken, and we subtract vacancy, the loss due to vacancy. So we get GAV, ER or AR, whichever is more, taken. So 2 lakh, and loss due to vacancy is 50,500, making GAV 149,500. So we write 1,49,500 here and subtract the municipal taxes paid by the owner, which is 10,000 rupees. So NAV comes as 1,39,500. Similar way we have for rest of the properties. These GAV values have been borrowed from the previous example. So GAV already computed for property 1, 1,49,500, deducting municipal taxes and getting annual value. Similarly, for property 2, 1,85,000. Although the municipal taxes have been paid in case of property 2, but they have been paid by tenant, therefore no deduction will be allowed to the owner of the house property, and this is written as nil. Therefore, the annual value or net annual value is as good as the gross annual value, which is 1,85,000. In case of property 3, the GAV is 1,56,750 and municipal taxes 20,000 paid by owner will be subtracted. And we get 1,36,750 rupees as the NAV. In case of property 4 again, the municipal taxes were paid by the tenant, therefore they are not allowed as deduction. Therefore, GAV and NAV remain same. In case of property 5, 13,000 is the municipal taxes paid by the owner. Therefore, this is subtracted from the GAV to get the annual value or net annual value of 57,500. Next, we come to deductions under section 24. There are 2 deductions available under section 24. 24 subsection A, which is standard deduction. This provides a flat rate of deduction, which is 30% of net annual value. And this is a statutory deduction, which is allowed towards repairs, maintenance of the house, collection of rent for the property, and this is allowed irrespective of the actual expenditure incurred by the assessee. So we are not concerned with the actual expenditure, whether incurred or not incurred on account of fire insurance or, for example, ground rent, land revenue or repairs, but we are providing this statutory deduction at a flat rate of 30% of NAV to all assessees. Interest on borrowed capital. If the assessee borrows money for the purposes of construction, acquisition, repairs, renewals, reconstruction of the property, then the interest on such loan is allowed as deduction under section 24, subsection B. Interest on borrowed capital is deductible fully without any maximum ceiling in case of a let out house property. So there is no ceiling, there is no limit. The interest on borrowed capital, the capital has been borrowed for construction, acquisition, repairs, renewals or reconstruction of the house property. So in a nutshell, we say that the home loan has been taken and interest has been paid, or I would say has been accrued, and therefore deduction is available. Specifying again that in case of a let out house property, the deduction on interest on borrowed capital is fully deductible without any maximum ceiling. Certain important points to consider. Interest on borrowed capital is allowed on accrual basis. Even if the interest has not been paid during the year, it will still be allowed. Home loan should be used for the house. If the borrowed amount is used for some other purposes, the interest will not be allowed as deduction. Penal interest for non-payment of interest is not allowed. While arranging the loan, you have to pay some brokerage or commission to the agent who's arranging the loan for you. Such kind of brokerage or commission paid is not allowed as deduction. Only the interest on the capital is allowed as deduction. As per Income Tax Circular number 28, dated August 20, 1969, the interest paid on a new loan taken to pay back the original loan is also allowed. At times it happens that you're not in a position to repay the original loan which was taken for maybe construction or acquisition of the house property. So you raise a new loan. So the interest paid on the new loan which has been taken to pay back the previous loan is also allowed. Interest paid to the lender located outside India will be allowed only if the tax has been deducted on that and also duly deposited with the government. Next, we come to the concept of pre-construction period and also the interest of the pre-construction period. When we borrow capital for constructing a house or acquiring a house or maybe repairs, renewal, etc., it might be a situation that the loan is taken but the house is not constructed in just a few days. So there is a concept of pre-construction period. And since you have borrowed loans, so you start paying interest, but you are not able to claim the deduction for those since the property is still not established and there is no income from house property from where you can claim deduction for the pre-construction period. So the interest of pre-construction period, the law suggests, is allowed. But this is not allowed in one go. It is allowed in 5 equal installments. So you have to find out the interest of pre-construction period, then divide it by 5 to get the annual installment. And this annual installment will be allowed as deduction starting from the year in which the acquisition or construction is completed. Important point to consider that this deduction is not allowed if the loan is utilized for repairs, renewal or reconstruction. So we are dealing with only the construction or acquisition of the property. And that is why the name given is pre-construction period. So what is the pre-construction period? The period commencing on the date of borrowing and ending on the date of repayment of loan or on March 31 immediately prior to the date of acquisition or completion of construction, whichever is earlier. So we have the opening date. We are saying it is a pre-construction period. It has to have an opening date, also a closing date. So opening date is fixed, which is date of borrowing. And the closing date, here we need to compare the two dates. One is March 31, immediately prior to the date of acquisition or completion of construction. And this is compared with date of repayment of loan. So whichever is earlier is the closing date for us, and it closes the pre-construction period. So opening date is very much clear, which is date of borrowing of the loan, and closing date is earlier of the two dates. So PCP is closed with the closing date here. Let us take an example where Ajay takes a home loan of rupees 4 lakh from Bank of India for the construction of the property. So first thing that we are borrowing the loan here for the construction or acquisition of the property. If the loan is borrowed for repairs, renewals or reconstruction of the property, then interest for PCP is not allowed. So here in the question it says there is a home loan of rupees 4 lakh from Bank of India for the construction of the house property. rate of interest is 10% per annum, and we need to compute the amount of interest which is allowed as deduction for the assessment year 21-22 in the following cases. Here we need to compute the amount of interest which is allowed as deduction for the assessment year 21-22 and in the following two cases. The date of borrowing, 1st April 2014. The date of completion of construction, 31st December 2017. And date of repayment of loan is 30th September 2027. So let us define what is PCP here. Pre-construction period starting from date of borrowing, which is 1st April 2014. And closing date will be 31st March immediately prior to the date of completion of construction. So 31st March prior to 31st December 2017 is 31st March 2017. And we need to compare this with the date of repayment of loan, that is 30th September 2027. So earlier of the two is taken and earlier of the two is 31st March 2017. So this becomes the closing date for us. Therefore, the PCP is 1st April 2014, 1st April 2014 till 31st March 2017. So we need to compute the interest for these years, and that interest of PCP will be the aggregate interest for the pre-construction period. That will be divided by 5 to get the annual installment. Let us see the PCP for the second case. The date of borrowing is 1st February 2017 and date of completion of construction is 23rd June 2019. So PCP with the date of borrowing 1st February 2017 and completion of construction happened on 23rd June 2019. So 31st March prior to the date of completion is 31st March 2019. We compare this with the date of repayment of loan, which is 31st January 2019. So 31st January 2019. We take whichever is earlier. So earlier is 31st January 2019. Therefore, PCP is 1st February 2017 till 31st January 2019. And the interest for the aggregate period is computed, and this is to be divided by 5 to get the annual installment. Now let us look at the table here. The pre-construction period, as we decided in case 1, is 1st April 2014 to 31st March 2017. The amount of loan or principal amount is 4 lakh rupees. The rate of interest is 10% per annum. Therefore, we multiply this with 36 divided by 12 because this PCP is becoming 3 years. 3 years converted into months will give 36, and therefore 1,20,000 becomes the interest of the PCP. And we divide it by 5 to get 24,000, which is interest annual installment. For what period the PCP interest will be allowed? It will be allowed starting from the year in which the construction is completed. So we have previous year 17-18 and 5 subsequent 4 previous years. So previous year 17-18, 18-19, 19-20, 20-21 and 21-22. That makes it 5 years. Loan outstanding in the current year, that is previous year 2021, yes. So there would be current year's interest as well, which is 4 lakh into 10%, which gives us 40,000. So the interest amount deductible in previous year 2021 will be 24,000 plus 40,000, which makes it 64,000. So here, when the property income is computed, we are giving the deduction for the pre-construction period as well, and we are giving the deduction for interest for the current year. In case B, the pre-construction period is 1st February 2017 to 31st January 2019, which is a 2 years period. So 4 lakh into 10% into 24 by 12, which gives us the aggregate interest of 80,000, divided by 5 will give 16,000. So this is annual installment. The PCP interest will be allowed in 5 equal installments starting from the year in which the construction gets completed. So previous year 1920 till previous year 23-24. Is loan outstanding in the current year? No. Therefore, current year's interest is nil and only 16,000, that is interest for the pre-construction period, is allowed in this example.